Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending February 1st, 2019. Wow, what a January. I guess I could also say, wow, what a December. I mean, we've seen a whipsaw that we haven't seen in quite some time. I mean, an extreme. The month of December was one of the worst months that we've had since 1931. I mean, we got to go back pretty far. And the markets were down a little over 9%, give or take, from the Dow to the Nasdaq to the S&P. Really bad. 70% of the S&P 500 companies, in fact, in the month of December went into a bear market, which was more than 20% down. That's 70%, guys. Then in January, we saw the best market that we've seen in the S&P since 1987. So we're almost a 8% gain, slightly under. The Dow had the best start since 1997. I mean, really, talk about a whipsaw. Since the December 26 lows through the end of January, I think we've seen the stock market move up on average a little bit over, just slightly under 16%. That's about a 6-week period. And that represents about 4 trillion in market value coming back into the markets. Now, what caused a lot of that? Well, we could probably say our wonderful PhDs from the central banks were causing a lot of havoc. And of course, there were other reasons, I believe, that the markets pull back as much as they did in the month of December. We had some panic selling. I think we were overdone just a little bit. But it didn't help when Powell kicked it off in early December by saying that quantitative tightening was on a autopilot kind of process. That really got the markets upset. Now, keep in mind, since 2008, the Feds have been on this quantitative easing where they've driven the interest rates down to effectively zero for almost a decade. Now, when you've got rates down that low for that long, it forces money into the equity markets. It builds up asset prices because money has nowhere to go. You guys remember the term TINA, there is no alternative, and that's what happened for 10 years. All of that quantitative easing came at a cost of building up the U.S. balance sheet to over 4.3 trillion. I think we started quantitative easing when the Fed balance sheet was maybe about 800 billion, something like that, 700 billion. But we added a tremendous amount. All of that money was injected into the markets, with the Feds bellying up to the bar and buying all of the treasury that came up for auction. It was the largest buyer in the market, of course. And that put a lot of liquidity in all the banks' hands and then obviously into the markets. And then it drove up in asset valuations and drove down interest rates. Now, with them starting quantitative tightening, they actually started it in Q4 of 2017. They didn't really announce it with a lot of fanfare. I think they started off with 10 or 15 billion a month in quantitative tightening, where they're actually just letting the bonds and notes and bills that they hold just run off the balance sheet, and they're not going to buy them or roll them over like they were doing for a decade. So what that means is it forces the market to come in and step up and be the buyer versus the Feds, okay? Because someone's got to buy them to continue to float the large debt of the U.S. market. So we can expect some of this liquidity to come back out of the market. Now, what's the ramifications of quantitative tightening? No one really knows. And Greenspan, when asked the question, he said, I don't know. We've never done this before. So there's going to be unintended consequences. There's going to be unintended correlations or correlations that people don't expect. But you can pretty well bet, based on the comments with Powell, that quantitative tightening certainly scares the markets to the tune of what we saw in December when he said autopilot. And he was also of the mindset they were going to hike at least 2 times in 2019. And then fast forward 3 weeks. Only 3 weeks, and the market sold off like it did in December, giving the Dow the worst December, as I said, since 1931. S&P worst December since 2018. I mean, it was really amazing. Then Powell, started getting the hints. The bond market had already said, "Oh no, au contraire, you're not going to be hiking rates next year." So the bond market did its own. The markets forced Powell back to the table. And then in early January, he came out and said, we're going to be patient, and we're going to be flexible, and kind of this quote unquote wait and see approach. He even did the same thing with QT, quantitative tightening. The markets obviously loved that, and it gave us the best January that we've had in quite some time. So the worst December to the best January, a lot of that was driven by the Feds. Okay. Now, all of this under the umbrella of reducing corporate profits, slower growth. And the other thing is during this decade of quantitative easing, we've seen the S&P deliver annual average returns of about 12% since 2008. That's huge. The normal run rate is almost half of that. So going forward over the next 2, 3, 4, 5 years, we can expect that to come back in, kind of like a Bollinger Band in a stock price. We're just not going to see these returns. They're going to get harder and harder. In fact, we're seeing everybody and their uncle forecasting slower growth. Okay. Does not mean that we're going to go into recession. I don't believe we're going to go into a recession, but I do believe growth is going to slow, and we're going to have these blistering returns anymore. And the Feds are in a pickle, because if we do go into a recession, we're going to hit it with interest rates 2.25% to under 3%. Last recession, we hit the interest rates were a little over 4.5% or so. And look at Europe; they're even worse. They're at negative interest rates for intrabank lending. So if we have a recession or something starts in China on a slowdown and then it moves to Europe, then to here, it could be ugly. There are a lot of different directions this market can go. I mean, we've got some encouraging news also, not in addition to the Feds, but from the U.S.-China trade talks. I believe Trump's going to get the deal done. I think he needs it pretty badly. I think Xi needs it pretty badly. So, put the two together in a toxic cocktail, and I think it's going to come out with a high alcoholic content. More booze for everybody. Even on the face of slowing corporate growth, I think price action should hold up. But again, we got these headwinds that are lurking out there. And the Feds, even though they said it's a wait and see kind of approach, that does not mean that patient and flexible approach. Don't confuse those words with the word done. I think the markets are even starting to price in a possible rate reduction later in the year. They're adding that to the forecast, the 30-day Fed Fund futures, going out 6 months to June. The markets are 5 months out to June already. The markets are only saying it's about a 25% chance of a rate hike. So the Feds are going to be very closely watched this year. And just judging by their actions or lack of actions, the markets are going to be extremely sensitive to what they're going to do. And under this wait and see approach and this flexible approach, that means all the market data that starts to hit the news wires, from inflation to PMI data to earnings, to all of this is going to be very closely watched by the Feds. And the markets could go back into what we were in during the quantitative easing period of what's good news is bad news and vice versa. So we're going to have to watch this very closely. So that's kind of what I'm seeing right now in the marketplace. What I've got on the screen is a weekly chart of the S&P 500 E-mini futures. You can see the trouble started in October, early in October, when Power Ranger Powell came out and started talking about the interest rates, and it just didn't bode very well. And the markets attempted a little bit of a rally in November, but Jerome Powell came out in early December and quashed that. You can see we came down to about the 2,600. It held up fairly nicely as we got into the beginning of November, and we actually rallied back up to the 2814 level. That's a 200-point reversal, folks. So keep that in mind. From the lows of October to starting December, the markets moved up 200 points. And then Powell came out and said what he said, and the markets immediately sold off from 2814, and they came down to an intraday low of 2316. Okay, so that's almost 500 S&P points in less than 3 weeks, because I will remind you, our lows were made on December 26, DECE 26. So within 3 week period, we gave up 500 points. That was ugly, ugly, ugly. Coupled with the holiday season, lack of liquidity in the markets, and his quantitative tightening statement, the markets just didn't want to have anything of it, and it sold off big time. Then, of course, he came back out in early January, made his comments, and then we're off to the races again. So we are off of the December 26 lows. We closed at 2704, and the December lows was 23.16. So I mean, you're looking, you know, at what, 400 points, roughly 380 point move in a 4 week period. It's really crazy. And all of this, I believe, is caused by those rat brain muckety mucks over at the Fed. They shifted policy. Now, what happens if we start getting data hitting the transom that says inflation's starting to pick up? He could be forced to reverse his course again in a very short period of time. Mind you, the markets are not pricing that in at this point in time, but anything can happen. But that just shows you the nature of this. Now, keep in mind, most technicians, me included, view this as a V bottom. V bottoms do happen, but I will say they're rare. All right, so we can expect a little bit of a give back of this money. Now, when will that happen? Well, Trump is really good at goosing the markets. And what we could see here is March 1 is their official deadline for trying to draw a deal. Trump is going to meet Xi when he's over in North Korea or over in the Asia Pacific area meeting with Kim Jong-un, and he's going to meet with President Xi. So that should happen sometime in the month of February. Also in the month of February, Lighthouser and the U.S. negotiating team is going to go over to China to try and wrap up some kind of deal that Xi and Trump can talk about. So that means we could probably see ourselves come back up to these key pivot levels right here, right around 28.14. If we get up in this area here, I'm going to be more than a happy camper, what we call in our group, happy pirates, right? So I'll just draw my little pirate patch on here like that and put a patch on this guy and give him a little smile. And we're going to be willing to short this up in this high area up here if we get up into this area right up here. I don't know, but the China deal could move us up there. So for all of you near-term traders, short-term traders, swing traders, especially scalps, day traders, we're going to have some action here coming up. Volatility actually closed the week down 7.3%. The VIX is sitting at 1614. We'll talk about that in a minute, as well as the term structure. So if we come back and let's put it on a daily chart, you can see right here. Oh, one other thing I will point out on this weekly chart, I didn't point it out before. You can see now this value, this market map goes back 90 periods. In this case, I'm using a weekly bar, so roughly 90 weeks, a little bit more than a year, okay? It goes back about a year and a half. And summer of 2017, you can see this yellow line right in the smack dab center of the screen right there. There's the yellow line. This line right here, sitting right around 2680, okay, just below the 2700 is where the biggest amount of volume has taken place in the E-minis going back this time frame. And then if we look up here, there's severe overhead resistance. This is where the least volume took place, where there's limited overhead folks willing to buy at that level. So because a lot of people were stuck in this down move right here, they've been waiting for this to get back up. And once it gets back up here and they get into at least a bit of profit, they're going to be happy sellers, okay? I don't think a lot of new money is going to be put to use up at this level up here. So this is going to serve as a huge, what we call our R1 value. And this R1 value is sitting right around these pivot points, maybe north of these pivot points by about 20 or 30 points, okay? So if we do get up in that area, I think the likelihood can be that we can get there. I'm going to be a happy camper because I'm going to be looking at taking shorts in the position, okay? Now, if we come down to the daily chart, just to kind of show you, You can see here on this daily chart, I've got the market map again that goes back 90 periods. So in this case, it'd be 90 days for each market map. And you can see these 3 market maps on here. And we're sandwiched on the low end side of 2640 and on the high end side of about 2786. Those are where the key value areas have been going back 270 periods on this daily chart. Okay. And if we zoom in right here, you can see that I've got this colored zone right here, which shows just limited resistance. And then we've got these key pivots up here, which are going to be much, much harder resistance, slightly over 2,800. I've been telling our members we're stuck in this sandwich between 2,600 and 2,800, this key pivot area here. This was the area, 2,600, that held up fairly nicely from the end of October, and then it finally gave it up in December when Powell made his statements, and that's when all hell came loose. And then it quickly came back in about 2.5 weeks. Okay, so the 2,600 is going to hold us up. You can see from the high to low, we were down 21.39%. So in the E-mini futures, we were in an official bear market intraday. And you can see that candle intraday was a bullish engulfing pattern. Okay, so we moved back up. Now, if I were to switch the screen and show you the Bollinger Band view of this chart, and let me just come up here and get the Bollinger Band view on here, you're going to see, and what I've done on this Bollinger Band is I've overlaid 3 standard deviations instead of the standard 2. The purple is the standard 2-dev Bollinger Band. The red is 3-dev. Okay, you can see we hit the red here in December. We made that December low at 2316.75. Now the highs are up here at 2716. Looking at a standard fib pullback, putting us right in the middle of the Bollinger Band would be right around 2621, a 23.6% pullback. We haven't really had much of a dip because we've had a lot of wind at our backs with the Feds and their statements. I mean, we had a little bit of a dip right here to start off January. Then we had this sideways pattern here leading up to the Fed announcement, and then we broke out to the upside right here. Okay, a retest of this area to me seems very natural. And still maintaining the bull run, which would mean a retest, back down to the lows of 2621. Okay. I don't see us getting much higher than this. We're a bit stretched. We've got some earnings coming out next week. We've also got Trump he's scheduled to deliver his State of the Union on Tuesday, the 5th. And I was telling our members, I wonder what the over and under is going to be on Pelosi and how many times she stands and collapse versus rolling her eyes. It'll be interesting to watch her expressions behind Trump. And the other over and under I'm going to look for is Ruth Bader Ginsburg, how many times she falls asleep or the cameras catch her napping during the speech, if she can make it to the speech. So that is going to be really interesting. So we've clearly got some things on the horizon that can goose the markets higher or lower. If we do get goosed up near term, I'm going to be a happy camper and want to sell any kind of rally, at least right now. That doesn't mean, nor do I think we're coming down here to test these lows down in this area here. But clearly coming back down into this area here, the 2600, I think makes a lot of sense to me. Okay, getting us back into the center of this Bollinger Band. Also look, the Bollinger Band, all deviations 1, 2, and 3 have dramatically tightened. So the width of the Bollinger Band is at this width right now, versus this width when we got into December, right? So we've just seen volatility come in dramatically. And the tighter this gets, this means this is just going to wind up for a bigger move up or down. And I think the odds are setting up for a move down. We could have a blast higher if we get the news on the China trade deal. And let's say the U.S. Congress gets together and they come out with a workable deal for the border security, then we could see an inadvertent rise higher. Even in that case, I'm going to be a happy seller into higher price action, at least on the short-term basis. So that's kind of what I'm looking at. The other chart I will show you, and I went into a lot of detail on the Uchimoku in our option masters. And for those of you not in our option masters, I highly encourage you to come in. So I'm not going to explain the details of how to read an Ichimoku in this weekly roundup. But I wanted to show you here on this daily chart. You can see here we broke through the cloud and we're now on a bullish bent here. We've got the span A and span B both showing that we can be bullish this chart. And then, of course, we've got future action here, this showing our S1, which is going to be our support, you know, right around the 2560 area, 2570 area. That would be our support. You can see the cross that we had that does indicate bullishness up to this area right here, which is what we got. You can see our lagging span right here, which is above price action, shows that we still want to be a little bit bullish, all right, although we've got a little bit of a pullback in mind. So I believe a pullback, you know, whether I'm looking at Bollinger Band chart, I'm looking at the Ichimoku chart, or I'm just looking at standard simple bar charts, you know, it would all kind of show the same thing, all right? And if we come back to the standard charting here, and we look at this, you can see Elliott wave count is also to the positive with an Elliott wave 3 here, which does suggest we can experience a 4-leg pullback. All right. So this is what I'm seeing in a little bit more of a detailed analysis of the S&P 500. Remember where it goes, most of the other markets kind of follow along as well. If we look at the, and notice here, the other thing I almost forgot to mention, we've got this, and I'm going to blow it up here on this daily chart. I'm surprised most people didn't talk about it, but we've got this upward vector in the 50 EMA. The 200, the vector of the 200 EMA is moving higher, and we actually penetrated this. So at this level here, and see some of this overhead resistance up here, is an area where the markets tend to pull back some. All right, we've had volatility come in. As I said, vol this week finished at 16.14. So we can expect a little bit of softening in price, but we're over the 200 EMA. That is good. The 50 is still below the 200, so the odds favor the 200 being the big resistance point. And if we look at the Dow, and we kind of take this approach, notice the Dow is sitting right south of its value area, this yellow bar here, which shows where all the volume took place going back 90 periods, or in this case, 90 days. All right, we're over the 200 EMA, which is good. We've got an upward vector in the 50 EMA, which is good. So we've got some solid support beneath us, all the way down to around the 24,500 area. We've made new 2019 highs, which isn't hard to do because we're just kicking off the year. We're only 4 weeks or 5 weeks into the year, but we've made 2019 highs across all indexes. If we look at the NASDAQ, we can see the NASDAQ also made 2019 highs. We're above the 200 EMA on the NASDAQ, all right? Just barely. But these are the areas where markets traditionally, when the 50 is below the 200, where markets start to give it up a bit. So if it starts to give it up, we do not need to panic. We just need to watch and make sure that our support levels hold, as I'm pointed out. In the NASDAQ, the support level is around 67.20, okay? So we're at 68.70, so about 150 points to the downside, which we've seen in NASDAQ can be done in one day. But this is kind of what I'm looking at. And then, of course, if we look at the Russell, which is mostly small cap, the Russell is the only one that got hurt the most, okay? You can see we're still well below the 200 EMA. This is small and mid cap. January, we did have a pair trade on with the Russell and the SPYs, which turned out very good. We were long the Russell and we were short the long IWM and short SPY. That was a good trade on a relative basis. But we're now coming up into some serious overhead resistance here as well. So I'm seeing across all major indexes, we're coming up to serious resistance. The odds favor us to stall out here and give back some, okay? Doesn't mean that we can't get a Trumpian tweet or a statement or something from Jerome Powell, which, by the way, he's going to be speaking this week. On Wednesday, he's going to be speaking at a town hall in Washington, D.C., and he's going to be doing a Q&A session. I don't have the time of it yet, but it's probably going to be mid-morning Eastern Standard Time. And as you guys know, Powell doesn't choose his words very well. So if you go to lunch and come back and the markets have moved 150 points, before you've even had a chance to finish your dessert and get a hot coffee, then you can pretty well bet. And if it's on Wednesday, then just check and see what the heck that man said. All right. I hate to see markets running like that, but it's just kind of a fact and reality right now. The Fang Index, which I created in e-signal charting, it's an index of all the major stocks from Google to Microsoft, Apple, Facebook, Amazon. You can see here, again, we had a V bottom, but we're below the 50 EMA. We've moved up. You can see we made a 2019 high, okay? And it is, I'm watching the Fang Index, which is an index of the major Fang stocks. And the fact that we're moving up without as much participation in Fang stocks, believe it or not, it's a good thing because we're seeing some sector rotation in other stocks, okay? But the Fangs demand a huge market cap or have a huge market cap for the market. So if Fangs start rolling over, just by nature of their market capitalization, they're going to drag the indexes down a little bit with them, okay? So you can see the Fangs are below the 200 EMA. We still have the 50 below the 200 EMA. So the odds favor a little bit of a pullback here as well, okay? If we look at volatility and we look at VIX, you can see the VIX. And we were short VXX, which is now VXXB, but we were short up in this area. And we had some nice money made on the short. And if I were to put on VXX just to show you, well, now it's VXXB, but it ran the same. You can see we were short up in this area here and rode it all the way down. So it was a really good move here for us in trading this. Remember, whenever you've got the put call ratio over, we use a ratio, and once we get over that favored ratio, we review it every Sunday night for our members. When you get over that ratio, we're going to pick up shorts in VXX or buy VXX puts if you don't want the exposure of shorting VXX or don't have the margin. Either way, the odds favor shorting the trade, okay? And you can see here it turned out to be a really good move. So if we go back to the VIX again, you can see the VIX is still in the yellow zone. We're over 15, we're under 22. It's putting us in the yellow zone here. So we're still got some fear out in the market. When we get back into the green, the VIX is getting below 15 roughly. And we haven't been below the green since once we hit this move right here, when we started moving back up, was right in October when the markets gave it all up. So you can see there's still fear in the markets. I mean, we're still elevated. But let's look at the front month term structure and then let's look at the back month term structure of volatility. These are very important, especially if you trade the option market or VXXB, because they play off of these big time. If we look at the front month term structure, which is the VIX compared to the February futures, you can see here we're just barely in the green, which means the February vol futures is slightly higher, not by much, by the tune of about 86 cents higher than the VIX, okay? That's what we want to see. So we're in the green, not by a little bit, but we are in the green on this daily chart here. Okay, so that's the front month term structure. That means we're in contango. A normal term structure is the further out in time you go, the higher volatility goes. So that's where we're sitting right now. If we look at the back month term structure, this compares February and March. Notice we're in a contango here too. That means the February vol futures are less than the March vol futures by 55 cents. All right, we're in the green. So the term structure has already started to come back in place, but we're still elevated. I'd like to get a little bit further away. Now, the term structure of February and March is how you need to understand in order to trade VXXB. Okay. Now, we go through that in detail in our option masters and how best to play the odds on these trades. And keep in mind, since the inception of VXX, which was in February of 2009, VXX is down about 99%. Okay. So if there ever was a constant short, VXX is it, or now VXXB, because VXXB runs exactly like VXX. The fund managers are going to run it exactly the same. Okay. So we want to basically be short, but not always short, because we're subject to risk of a severe bear market. Okay. So we want to pick our entries and exits in VXXB, whether we're long puts or we're short VXXB. Okay. The ETN itself. So we use these term structures and we use put call ratios as well as the skew index to help us out. So for those of you that are non-members, I highly encourage you to come in and check it out, because it really adds some alpha to your overall annualized returns. Alpha is basically that much more than you would have gotten otherwise, better than the performance of the S&P. Okay, so that's a little bit about volatility, guys. If we come in and we look at the bond market, now naturally we had here this breakout of this regression line. Remember when I showed it a couple of weeks ago, or I was showing our members, if you have a break here, then you want to go long. Okay, we had this topping pattern here, which suggested a short, which was an Elliott wave 4. This tends to suggest a higher move in the bond market, which means a lower move in interest rates. We certainly got the impetus for that with Jerome Powell. And that's not to say that we can run up and take these new highs right here at 148 and 27 ticks and take it out. But the odds favor interest rates kind of staying in this range to slightly higher. Okay. If we look at the interest rates, if we look at the 10-year, well, let me find the 10-year interest rates right here. If you look at the 10-year interest rates, it's just the opposite. Okay. It's suggesting a move lower, all the way down to around 2.5. Now, folks, in the scheme of things, this isn't good for the markets, because if interest rates are going lower, that tends to build asset bubbles, and it tends to mean that people are buying bonds, not for the interest rate, but for safety, because when you buy anything, it goes up, or if a lot of buyers come in, it goes up. And if bonds go up, interest rates go down. So this could be a forewarning of a little bit of a pullback that we could see come. Okay. If we look at currencies, well, let's look at our buddy, the British pound. They're certainly going through a lot of machinations. Now look at the pound. You may be thinking, why the hell is the pound off of 1.24 to the dollar all the way up to 1.31 to the dollar? That's a big move in the currency markets. And the big reason why the pound has moved higher, even with all this Brexit turmoil, is that the markets are betting that politicians are going to be, well, they're going to be politicians, which means they're going to probably put off the Brexit vote for another year in hopes of a referendum vote, in hopes of staying in the EU or having a soft Brexit. So I'm not in the British pound at this point in time, but that is the reason why we're seeing the pound move up. I think it's going to get really choppy as we move forward in Q1, because there is a risk of a hard Brexit, although they voted that they don't want that. So the bigger potential risk of the pound is that they have a let's put off the vote kind of thing, and that means the price of the pound is going to go higher. Okay. If we look at the euro is basically there. It's stuck. I don't think it's going to go much higher nor much lower. If anything, it's going to go lower, because Europe is not doing very well right now. All of their PMI data, their manufacturing information, the purchasing managers index, everything is showing slowing growth. And clearly, if Great Britain pulls away from Europe, that could cause some import-export issues depending on the Brexit, which is going to further hurt Europe, the ECB, the 19 countries that make it up. So if anything, we're in a range bound to slightly lower, which would suggest the US dollar range bound to slightly higher, okay? Now remember, I put this regression channel in expecting the dollar to come down. We broke it, right? We're following my course, but I don't think there's much more downside right now. The only thing that's going to cause this to go lower, remember, it's not a dollar currency, it's the dollar index, because it's based on 5 other currencies, of which the pound is about 58% of the value of where the US dollar index goes. So if the pound falls and other currencies like the yen or the Swiss franc, they go, or the Canadian dollar, they go lower, it's going to push the dollar higher, or vice versa. So it's really a factor of where the rest of the planet is, right? Remember, the rest of the planet can be really underwater and really crappy, and the US can be crappy as well, yet the dollar is going to go up just because we're the only pig in the pen with lipstick. So this is kind of where we're sitting now with the currency market. If we look at oil, okay, remember with oil, I had said probably around the 55 area off of these lows. We got up into this area. Once we got up around 54.50 area, I said expect a little bit of a pullback. I'm still expecting a pullback. We extended a little bit higher, but I am expecting a pullback in oil. We've got that big issue with Venezuela right now, where we recognize Guaido as the effective ruler versus that knucklehead that's running it right now. So what we can see here is if we support him and he wins, he is going to immediately, they're going to start exporting a ton of oil, because we've stopped buying oil from him, and depending on how tough Trump is going to get, which I think he's going to get pretty hard, he's going to effectively cut off their oil exports and starve them. Maybe a bad choice of words, but he's going to starve their money supply coming in. The reason why China and Russia are supporting him is they've loaned him hundreds of billions of dollars. And they stand to lose, because if Guaido takes over, he's going to declare all of those loans. He's going to bankrupt those loans, and then those countries are going to lose out. And then the U.S. is going to support him. So there is some machinations going on behind the scenes. And if he wins, oil is going to come down, because he's going to put a lot of oil back on the market again. That's going to increase supply, increase inventory levels. So there's a lot of geopolitical politics going on with oil right now besides simple supply and demand. And we've just got to watch that. Remember, my call back over here when oil was up in this area here, with all the looming issues around the economy and what Trump was saying, I said we got to short oil or go short. I was expecting oil to hold up right around down in this area here around the low 60s. It blew right through it, actually went down to the low 40s. So it went a lot further than I thought, but we had members take the trade and made some really good money on the trade. Okay. Now down in this area here, I was saying oil around the mid 50s. That's kind of where we're sitting right now at 55.26, but I do believe we're going to have a slight pullback in oil. Okay, it's going to also run based on what happens out of Venezuela. Gasoline, same thing. Gasoline inventories are very high. We're sitting at a value area here. It's going to be very difficult for gas to get much higher with this overabundance of gasoline in the markets right now. The odds favor a sideways pattern to slightly down in gasoline. Nat gas, well, what can I say? When we were up in this area here, we took a short in nat gas. We did very well. It got back up into this area here, and I'd suggested a short again. We put on a short position. I'd said any bounce here is going to be worth shorting. I got out of it a little bit too soon. I think some of our members stayed in, made some money, came right back down to a point here around the 267 area, because nat gas has just got so much inventory. Huge supplies of gasoline, even with this polar vortex and all the use of nat gas and all these utility companies saying to cut your thermostat lower. We're running out of nat gas. We don't have the pipeline to support bringing in more. blah, blah, blah. It's still pushing natural gas lower. You would think logically nat gas would be back up in this area here, but it's not. So when we got elevated up in here, this was the big trade back up in here when we were shorting nat gas. Okay. If we look at gold, gold is another one that again, on a daily chart, I was talking about going long gold. You can see this nice little kind of cup and saucer or cup and handle pattern that we had. The dip for this handle was a lot less shallow. I would have liked to have seen it be a little bit deeper, but it did take a dip nonetheless. And right in this area down here, down the bottom of this rounded base pattern, I was suggesting doing bull put spreads in the gold futures market. We've had some good moves in gold. I mean, we went from 1246 all the way down to 1197. So we've seen 46-point moves, contra trend or counter trend moves from that up move, right? I mean, we've seen 46 points there. We went from 1218 down to 1182. So we've seen almost a 40-point move, contra move there, or a counter move there. So we've had these counter moves. But it still does not take away the fact that I've been bullish. I've encouraged our members to look at bullish plays in GLD, GDX, or gold futures. Okay, so that's kind of where we're sitting there. You can see we pull back just a little bit. I think a little bit of a give back, but generally when we broke this area here, the forecast of the technical pattern suggests normally a 10% run up from here. So that's right at about 1300. So a 10% run up is about 130 points over a 4-5 month period. If we look at it on a weekly chart, and I put our market map out here just to kind of give us an idea of where some of the volume sits, you can see not a lot sits up here. It's open space, right? I mean, if I were to reduce it down, there is not a lot sitting in the way. If we break this area up here around 1380, it's open field running up to the 1400, 1420 area here, okay? So I think we're going to probably settle in here a bit, but then if we break the 1350, 1370 area, folks, it's going to run. It's already been running for those that have been following along with us, and you've got some nice profits or should have some nice profits in the trade. But this is kind of where we're sitting on the gold chart here. Same thing with silver futures. All right, silver futures is the same thing. Down in this area here, we picked up shares of SLV. You can see that pullback here now in silver futures. It's $5,000 a point. Went from 1596 all the way down to about 1519. Okay, so about an 80-cent move. That's about $4,000 on a futures contract, but it quickly made it right back up again. So we're going to be stuck in this area for a little bit. And we had an early warning here with these exhaustion bars showing right in this area here to, maybe take some profits from this move down here. And SLV was also just as good, because if we look at SLV, if you want to simulate a futures trade, just do 5,000 shares. We're running a little bit less than that, about 2,000 or 3,000 shares, but we were in these shares down in this area here, and it's moved up very nicely. If you look at our market map, there is another area here that it can run to and find resistance at 1550. That's about 60 cents higher from where we are right now. Okay. Which on 2,000, 3,000 shares, it's a nice move percentage wise. So we're in a little bit of a pullback mode. I would use any pullback here as a buy the dip. All right, we've also got ag and we've got others in meats and softs, but and with the China coming out saying they're going to be buying tons of soybeans and others, there's going to be some opportunities there as well. All right, everybody, that's kind of where we're sitting. Members, I will see you this Sunday night in our weekly market watch. If you're not a member, I highly encourage you to come in. We're making money, guys. 2019 is going to be a very interesting year, more so than 2018, especially in the commodity market. I think we're going to have some pretty good plays here. All right, everybody, have a really great weekend. Members, I'll see you this Sunday night. Take care, folks. Ciao.